Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we had a big EIA day with those big adjustments that we were talking about with the Texas freeze-off. What does it mean? And what we've been saying the whole time was that there was a huge drop in refinery throughput that really outpaced what the drop in production was. So now that we saw production come back quickly, and some of these refiners stayed down longer, this is where we saw this huge shift, if you will, where oil had a big build and then the refined products had a big drop. Now that will start to offset as things start to normalize, as we see runs coming back up. You know, that is still going to be a little bit slower just given where demand is in general. But again, there's still something we'll start to see some of these adjustments, and we'll go through what those are in general. So in the first part, we're going to go through the overall numbers. What do we think for the crude draw, the crude build? How will that abate over the next few weeks? Then we're going to look at refined products. They obviously had a huge draw. What does that mean going forward? And then when we go into the last segment, we're going to look at U.S. exports, and then what do we expect coming into the OPEC meeting that's going to kick off tomorrow into Friday. So getting to the curve here, just to give you a little bit of an idea of where we sit. So everything was pulled back above that the $50 line, with a large part of capacity essentially going out through 2022. You can get above 55 when we're thinking about the backwardation that's in the curve right now, and the whole curve has shifted up and flatlined. Just given where we are and what are the expectations going into OPEC, because Saudi has been saying that they're considering potentially keeping the same levels in March into April. Russia's been saying something a little bit different, but there's some opportunity for that to adjust a bit, because Saudi Arabia could take away or remove some of those voluntary cuts that they issued for February and March. So again, these are things that we're going to look at and we'll talk about more in the third segment. But one thing to consider when we're thinking about how are people positioned, this is looking at managed money net long contracts combined in Brent, and you can see that it still remains at an all-time high, setting a new high record by a couple of thousand, about 1,000 contracts. So you can see that most people are net long going into the meeting, going into what's been happening. There's been a lot of movements in terms of people positioning for the reopening trade, the inflation trade. So this is where you can kind of see what that really looks like when you think about the amount of contracts out there. But one of the things that we keep pointing to, and this is something that we'll talk about more in the third segment as well. But when we look at China, so China's starting to come back. This is a little bit dated, but based on what we're seeing, it's coming closer to where North America is right now. But North America has hit this a little bit of a flat line, and we'll talk about why that's the case when we weigh between weekend and weekday, and how the weekday still remains sluggish as the weekend has essentially pretty much normalized. And as we look at California, we look at Texas, we look at Mississippi. Texas and Mississippi have a full reopening. California has lifted a lot of the restrictions. So there are things that will help support some of that driving demand on the weekends. But when are companies going to have people come back into the office, or will they come back into the office? And those are things that we'll talk about. But when we look in general, when we look at the rest of Asia, Europe, North America, we still remain at a fairly flattish level where we're just going sideways at these points in time. But we think that North America will continue to see a little bit of a recovery, which we'll go through in more detail in the second segment. So just looking at the stock build, I don't think there should be any real surprise, just given what the drop was on the refining side. But here you can see that obviously the build was driven by PADD 3. It had a build of 20.86 million barrels. So that takes us well over the year-over-year, the 5-year average. But again, we'll get a reversal to a certain extent. The problem is the export side, because we see a lot of slowdowns when we're looking at exports in general. And then when we look at crude oil production, this report only picked up a 300,000 barrel a day increase. And right now we've seen a much bigger increase, and it's not fully back. There's still about 250,000 barrels a day that are offline, but which means that we should be closer now to about 10.7. So we still have about 10.7 coming back. You know, as of today, we got even some new estimates on refining that are trying to come back. They're testing equipment, so they'll be back by the end of, you know, let's just say Friday to be cautious. But we're still seeing about 1.5 to 1.7 million barrels a day of refining capacity offline, which again, between exports being slow and refining throughput being reduced in general, that's going to keep some of these builds going, especially in Cushing, where production is going up and there's just not that pull down into Pad 3, which will keep some of that capacity in Cushing, obviously keep Pad 3 elevated. But when we look at Pad 1, Pad 2, Pad 5, you know, things look fairly stable, and there's not too much to say that that's going to change just based on what we're seeing in the water. But what we are seeing in the water is a huge surge of imports of refined products, which shouldn't be surprising given where the arb really went to, getting product out of Asia into Pad 5 and getting product from Europe into Pad 1. And that's going to continue. And just to give you some numbers, and then we'll go through some more numbers later, but U.S. imports of gasoline from Europe rose for a second week for the 7 days ending February 25th. That has continued through March 3rd. Gasoline imports rose to 242,000 barrels a day from 193 the previous week. Again, that's the walk-up that we're talking about. And the diesel cargoes, we had another 310,000 barrels also arrive, and that's going to continue. But again, we'll talk about that in a minute. And when we look at inventories, obviously we had a big spike. You know, there's nothing that, so the builds will start to abate just again as we start to see that pull through, but we think that there's going to be some more residual at least through next week, just given that we still have refiners down, we have production that's come back, and that's going to be the mismatch that will remain. And here you can see obviously where Pad 3 really went, that hard reversal. So that again, there's nothing to say that you know, this we'll see a bigger drawdown in Pad 3. It's just, you know, we have to think about this on a 4-week rolling average just to try to take out some of that noise that really started to appear. So, but then when we look at Cushing, you can see that there was a small that build and then that small steady increase, and that's going to be more reflective of production coming back and exports, and just Pad 3 still struggling to come back online, which will leave some of those barrels up in Cushing. And then when this is coming to what's happening on the import side. So you can see Pad 2 was actually the big spike in those imports. And as we said last week, we saw some increases in Pad 5 and Pad 1 just based on what was happening at the coast and what was coming down from Canada. So Pad 3 is still low. And again, Pad 3 is going to marry with as the refiners come back. So that's where we remain. Some of that crude will stay in Cushing. Some of that crude will stay offshore as they try to kind of manage some of this flow through back through the system. But Pad 2 will come down. Pad 5 will stay elevated if you look at the year over year, but start to come down. Pad 1 will see some pretty steady flow just based on some of the crude loadings and just timing at this point. And then runs, it's, we over the last 2 years, we've seen a lot of all-time highs, all-time lows. So here's where we're looking at refining throughput. This is a all-time low. When this is taking into account hurricanes and everything else, we had a huge drop to 56%. And clearly you can see it was a Pad 3 impact that took about 2 million barrels a day out of the market, or 2.1. Bringing us to a drop of utilization rate of 12.6%. Now that will start to reverse. We saw it starting to come through last week as we went from that 83 to 68, then obviously the 68 to 56. So now we've seen all of the pain, and now we'll start to walk back up. We're not going to just snap back to that level because we're still gonna have at least 1 million barrels a day offline. From Pad 3, it's just going to be a matter of how quickly do they come back. Pad 2 has seen some normalization, but again, it's going to be Pad 3 that is going to be the one to watch on that spike back. Implied demand, you know, as we were saying on the gasoline side, we expected a big spike just because there was a slowdown where gas stations ran out of gasoline. You had a pipeline down going into Chicago. So there had to be that movement where we had all of this product that was sitting in storage. It had to get pulled into the system. And this is something that is not, we're going to see another increase. Now, it's not going to be a big increase from that 8.1. It could go to 8.2. But again, we're starting to get closer to where we think we're going to see activity go through the rest of March and then start to gradually increase into April. You know, distillate was the one that we remain bearish on just because we think that now that some of these people have seen their heating oil refilled, you know, there was a huge cold snap that is now adjusted, and we'll talk about that in the last segment. But there's going to be some of that balancing act on the disty side. On the jet fuel side, we're starting to see the normal increase that we see in March. It's coming through this year, obviously at a lower level. So this is going to support some additional jet fuel. Again, we're not going to get back to the highs that we saw at the beginning of the year, as you know, especially as we had that refill post-holiday. But there's going to be a little bit of a stable demand level between that 900 to a million barrels a day, which will be supportive. And then obviously propane. A lot of disruptions, a lot of movement. So this is something that is going to remain moving through the system. But now that we've started to backfill, again, the demand will start to pare back. But we should get to that year-over-year level. So there's still more upside to see over the next week or two. You know, this is what we were talking about with floating storage. You know, some of the crude that should have been coming on board, coming on shore, was left offshore, and we expected to come into the bottom of the range. Here we are. Just how quickly the refiners will come back, which it looks like it's going to be at least another week or two. That will keep us in the bottom of the range. It's not going to get us to the 5-year high, but again, we'll be at the bottom of that cloud. And here's where we look at Pad 3, where we're starting to see a little bit of a bounce off the bottom. You know, we had obviously the Texas blackout shock to the downside, and this will slowly grind back up, you know, getting to the bottom of the cloud as, again, these refiners come back on and start to bring crude back through the system. Now, Pad 2, as we were saying, we had an overshoot to the downside, so we figured we were going to get a spike back up. Now we had an overshoot to the upside. There's a little bit of noise in this, and that's why there's always that average move. And you can see, just if you take the averages here, we're still trending just above that 5-year average, which is where we think we're going to be, just as that demand continues to be robust for Canadian crude, for the heavier oil coming into the Midwest specifically. And this is just a chart that shows you the massive extent of the downturn that we saw from the refining side. And, you know, clearly we're going to get that bounce, but we're still going to bounce closer to the bottom of where we saw the COVID disruption. So again, we're going to get back to that low, but it's not going to be, it's going to be in stages where and just think about the complexity of a refiner versus the complexity of an oil well. So again, it takes more time. You have to go through your testing, because when you're introducing heat and chemicals to a volatile fluid, you want to make sure that everything is in the right working order. So that will take some time, and that's just really that difference that we'll see. But again, as it comes back, it'll start to pull some of that crude out of storage, and then it'll start to backfill where we see some of these product draws, which we'll go through in more detail in the next segment.